Most people think that the way you get rich is by buying real estate. You've probably heard the phrase, more millionaires are made in real estate than anything else. But that's not true. You don't get rich by buying real estate. And in this video, I'm going to show you the real reasons why rich people buy real estate and why you can use the same strategies that they do. Growing up, I had no idea what real estate investing was. I had no real estate investors in my family. I was never exposed to real estate investing. But then I read this little book called Rich Dad, Poor Dad by Robert Kiyosaki. And in that book, he talked about this thing called real estate investing. And that's when I realized that, oh, I could go out and buy a property, rent it out, and somebody else can then live in or use my property, and then they pay me rent. Sign me up for that. Then I read book after book on real estate investing, and then I started doing it myself. Now, I was very fortunate that I started investing in real estate at the bottom of the 2008 crash, so I was very lucky with timing. So real estate was at rock bottom prices, but what I learned very quickly is that it's very difficult for 99% of America to become rich by buying and investing in real estate. Real estate investing is when you buy a property for the purposes of generating cash flow by renting out this property. So if I wanted to go out and buy this $500,000 property, and we can make it a single family home, an apartment complex, it does not matter. Well, there's a couple ways that I can do that. Number one is I can go out with $500,000 in my bank account and then go out and buy this property. Now, when I invest in real estate, I am looking for a 7% cash on cash return on my money, meaning that for every dollar that I invest, I want 7 cents of cash flow profit hitting my bank account every year. So if I have $500,000 in my bank account, I go out and buy this property and I want the 7% return. That means that I'm going to get $35,000 a year of cash flow from this property, assuming I bought it all cash. It's going to be very difficult for me to get rich with this $35,000 a year of cash flow, and I need $500,000 to get started. And most people don't have $500,000 to get started. So what do? Well, you're going to put down a down payment and finance the rest. If I put down 20%, which in this case would be $100,000, that means I'm going to finance the other $400,000. That also means that I'm not going to get all $35,000 in my pocket because I got to pay the bank. Now, for the purposes of this example, if I'm putting down $100,000 and I can get the same 7% yield on my $100,000, that means now my return is going to drop to $7,000 a year from profit. Again, it's going to be very hard for me to get rich with $7,000 a year of cash flow, and I still need $100,000 to get started. This is where everybody says, but Jaspreet, you could just sell this property for a big profit. What if you can sell this property for $1 million? Well, now you can make a lot of money. Sure, but that assumes that you can sell this property for $1 million. How many years is it going to take for this property to appreciate in value? And what happens if you see a slowdown in real estate prices? Because real estate prices don't always go up. Now remember, I'm talking about real estate investing. I'm not talking about real estate flipping or real estate developing. Real estate flipping is now where I come in and I buy this property. I'm going to add in some renovations. I'm going to put money into the property to make it even nicer. That way I can sell it for $700,000. That's not investing. That's flipping. It's like trading. I'm not a flipper. I'm an investor. Real estate developing is now where I'm going to buy the land and I'm going to build a property on top of it. That way I can sell it for a big profit. Or I'm going to come and buy this property, demolish it, and build something else on top of it. That is not real estate investing. That's real estate developing. Both developing and flipping can be great ways to make money, but they're not real estate investing. Real estate investing is when you buy a property for the purposes of generating cash flow, and it is pretty much impossible for 99% of people to get rich by investing in real estate. And the reason why I say 99% of people is because there's always that one person. Real estate investing is something that you do when you have money, that way you can start generating the cash flow. That way you can start getting the tax breaks, and that way then you can actually save your money into a hard asset. When you try to go and get rich by investing in real estate, without talking about flipping, without talking about developing, now you have to start with nothing. And if you have nothing to go out and buy a property, that means now you have to make much riskier decisions. That means now you're going to have to go in and you're going to have to do a lot higher leverage. Maybe you're doing 100% finance deals. And again, this will work for a small percentage of people, but for the vast majority of people, that means way more risk and way more chances of you being foreclosed on. And I'm telling you from personal experience because I have come in and bought multiple deals from banks and from lenders who foreclosed upon buyers and investors who bought properties with little to nothing down on the hopes of getting rich by investing in real estate. And now what happens? They're over leveraged. They don't know how to manage the properties. They don't know how to manage the deals. They don't know how to manage the finances. And then they got so over levered, they couldn't keep making their expenses. The bank took the property back and then they sell it at a discount to somebody else. And in this case, me. Real estate investing is a great way for you to invest your money, period. But you have to know how to invest your money in the right way, and you have to know what type of returns to expect on your money. There are three main reasons why rich people invest their money in real estate. And when I say invest their money in real estate, I'm not saying they buy a big home to live in themselves. I'm saying they go out and invest in rental properties. They invest in cash flow producing real estate. And number one is because of the tax breaks. This right here is the federal income tax code. This is over 2,000 pages long. And what it says is this is what income is, these are what your deductions are, these are what your write-offs are. And I can tell you I have this because I went through law school. And what I can tell you as an attorney, who's not your attorney, is that real estate has some of the biggest and most powerful tax deductions and write-offs that our tax code has to offer. By the way, this book is over 2,000 pages long. Number one is because of the deductions you get, aka write-offs. Now, before you go and implement any of the things that I talk about, talk to an accountant in your area. This is not financial advice. You have to talk to an accountant because all these things are very heavily regulated. So you want to make sure that whatever you're doing is legal. You don't want to run into red flags or run into issues with the IRS. Number one, with deductions, when you invest in real estate, you are essentially starting a business, and your business is investing in real estate, and businesses get to write off some of their business expenses. What can some of these business expenses include? Well, if you're investing in real estate, you need a car to get to and from work. You can potentially write off a piece of your car, or the car value, or your lease, or your car payment. You need gas. You can write off some of your gas. You need a cell phone to operate your business. You can write off some of your cell phone. You might need meals. You can write off some of these meals. So there are many write-offs that you can use, deductions, because now you are investing in real estate, which lower your taxable income. See, for most people, when you're a W-2, when you're an employee, the way that your income statement looks is you make money, then you pay taxes, and then after you pay taxes, that's when you pay for your expenses. But when you own a business or if you own real estate investments, now it's kind of flipped. Now what you do is you make money, and then you pay for your expenses. Now, of course, you can't write off things that aren't related to your business, but you have to be smart here, and your accountant's going to work with you to see how you can write off the most things possible legally. That way now you can file more expenses legally. No, you pay these expenses and then you pay taxes on whatever's left. That means now you have a lower taxable income. If you have a lower taxable income, that's a lower tax bracket, meaning lower tax rates. Not only are you paying less dollars in taxes, but you're also paying a lower tax rate because now your expenses are here instead of here. Then after your deductions, you also get the value of depreciation, which means you get to tell the IRS, hey, my property is a year older. It has wear and tear, and because of that, I deserve a tax write-off on my taxes. Even if your property is more valuable, even if you have no real physical wear and tear, you still get to write off this depreciation against your taxes, which means you get more money in your pocket while paying less money in taxes. Let me show you. Going back to this example that I gave you earlier, where I bought this property for $500,000, and assuming that I buy it all cash, I'm going to get $35,000 worth of profit. This is the cash in my bank account at the end of the year. Well, in residential real estate, so this is homes, single-family homes or duplexes, in this type of residential real estate, you get a 27.5-year straight-line depreciation. I'll explain what that means. That's what it is at the time of me recording, and for commercial buildings, it's 39-year straight-line depreciation. What that means now is you can take the value of the property, divide it by 27.5 years, and that's how much you can deduct from your income, from your profit every year over that 27.5 years, just because your property is older. So how do you do that? Well, let's assume now for this $500,000 property, $100,000 is the value of the land and $400,000 is the value of the building. You can't depreciate the value of the land, but you can depreciate the value of the building. So now you take this $400,000 and you're going to divide it by 27.5, which equals about $14,500. This is how much you can write off from your taxes every year just because your property is 1 year older. So now I go to the IRS, I say, okay, I'm at $35,000, and we'll assume that I have no deductions for the purposes of this example. And now we get to subtract $14,500 $500 from my taxes. Remember, I still have 35 grand in my bank account. But on my taxes, I'm gonna write off this $14,500, which means my taxable income is $20,500. Now again, I have $35,000 in my bank account to spend, but I'm gonna tell the IRS I'm only gonna pay taxes on this $20,500, which means not only do I have to pay less money in taxes, but again, lower tax bracket because I have less income. But this is where things get really fun, because what happens if I didn't buy this property all cash? What if I use debt, like I talked about earlier? Now, in this example, I'm only going to pay taxes on my $20,500, even though I made $35,000 of profit. But if I bought this property with a mortgage, now remember, I only had a $7,000 profit. So $7,000 worth of profit, but then I get to deduct this $14,500. So now I subtract this $14,500 and I have this negative $7,500 loss. I tell the IRS, hey, I lost money. I have this $7,500 loss, even though I have the 7 grand in my pocket. I made $7,000 on a financial cash basis. But in terms of taxes, I showed the IRS that I lost $7,500. Now, what you could potentially do if you qualify with your income, this is not for everybody, but some people are then going to be able to take this loss and deduct it against their own income. Now, at the time of me recording this video, in order for you to be able to deduct this loss against your ordinary income, your income from your job, you have to be making under $100,000 a year. And after $100,000 a year, this deduction gets faded out up until $150,000 a year. And the maximum that you can deduct is $25,000 in 1 year. And you also have to prove that you're actively involved in real estate. You have to show that you are some sort of real estate professional with your real estate investment. So again, this is why you want to make sure you have a good accountant on your side to do this. But there are ways for you to deduct some of this income against your ordinary income, the money you make from your job. Now, this is where things get even more interesting, because what if now you make more money, you don't have a job? What can you do then? Well, you can also carry forward this loss into future years. So now if you make a profit in a future year, well, now you can say, well, in the previous year I had this big loss, and you can keep carrying forward this loss. You're making money, but you don't have to pay any taxes. And the third big tax break that you get is something called the 1031 exchange, which says that you can sell your real estate for a profit and not have to pay any money in taxes if you take your profits and buy another property. So let's jump back to this previous example. You buy this home for $500,000. Now let's assume you own this property for a number of years. It's paying you cash flow, but then you're able to sell this property for $1 million. Pretty good. You made $500,000 of profit. Now you're also going to have to pay taxes on this $500,000 worth of profit, right? Well, maybe. Normally you would, but with real estate, you get this 1031 exchange, which says, okay, you have this $500,000 worth of profit, which would be taxable, but if you take this $1 million and you invest all of it into a bigger property, well, now you don't have to pay any money in taxes today. And now you can keep flipping this real estate year after year after year. You have to hold the property for just longer than a year, so you can't do this in 6 months. This is why you have to be an actual real estate investor. And then you have to buy bigger properties. Now, if you do this until you die, you never have to pay any taxes on this. But if you keep doing this 1031 exchange, you don't have to pay any taxes on the profits of this property. Now, again, this is very tricky. There are many regulations on this, so make sure you have a good real estate accountant and a good real estate attorney that will help you do this. So don't just go and blindly do this and expect not to pay any money in taxes, because if you just do this and you do it wrong, not only are you going to pay taxes, you're also going to pay penalties and fines. So make sure you have a good team, a good real estate accountant, and a good real estate attorney. Now this brings me to the second reason why people love investing their money in real estate, which has to do with saving hard money. Now, of course, if you are a real estate investor and you want to stay up to date on what's happening in terms of the real estate market and the stock market and crypto and our economy and the global economy, then if you haven't already, join Market Briefs. Market Briefs is a completely free resource that I created to help you stay up to date on what's happening in the financial markets. It's a daily financial newsletter that breaks down what's happening in all the financial markets into a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning. It's super easy to read. So even if you don't have a financial background, not only are you going to understand what's happening, but you're going to look forward to reading Market Briefs every morning. And the best part is it's completely free. So if you haven't joined Market Briefs yet, I'll put the link to how you can join Market Briefs down in the description below. The second benefit that you get for investing in real estate is you are investing your money into a hard asset. A hard asset is a real physical asset as opposed to saving your money cash, because cash is just pieces of paper, and potentially saving your money in the stock market because the stock market is also liquid and a paper asset, which means that you really don't own anything physical, anything tangible. When you own real estate, the actual property, not only do you own the land, you own the building, you own the bricks, you own the windows, you own the doors, you own the fixtures, you own the carpets. You own something physical, something that you can see, feel, and touch. Now, there's a couple benefits to this. The first benefit is diversifying your savings away from cash, because if you look at historically, our cash has been losing value for decades now because of inflation. Now, sure, in the short term, you can see swings up and down with the dollar, but over the long term, our dollar is losing value because we keep printing more money. And as you print more money without producing more wealth, the value of the dollar drops. So this inherently makes real estate more valuable over time because, well, the value of the dollars that buy the real estate are going down in value, which makes real estate more expensive, even if it's not necessarily more valuable, because the currency that you're using to buy the real estate is dropping in value. Now, of course, you're going to have short-term swings up and down in this, but over the long term, that's what inflation is. And so when you buy real estate, the second reason why especially rich people like the idea of owning real estate is because most banks are only FDIC insured up to $250,000 per person, which means if you have millions of dollars sitting in a bank and that bank were to go under, well, now that cash that you have sitting in the bank is also at risk. So if you invest your money in real estate, well, now you're a little bit more protected. Now the risk is, what happens to real estate if something happens and it burns down? Well, you have real estate insurance. And so you have protections against your real estate that you don't necessarily have if you keep all of your cash in the bank. Now, of course, real estate has risks too, because the value of real estate can drop. When the 2008 real estate crash happened, real estate prices in Michigan fell by more than 90%. You had some properties fallen by 92%. And so you do have your own risks with real estate, but there is a benefit to owning real estate because you also own this hard asset. And the nice thing with real estate, what we've seen throughout time, is that if you own good real estate, really any good investment, and you hold on to it through the bad times, then you should be able to recover your losses. Now, of course, investing has risks. You're never guaranteed to make money when you invest. You might even lose money, which is why you should always do your own due diligence and never blindly listen to a random guy on YouTube, but understanding that real estate has some risks, but the benefit as a hard asset is you own something that you can see, feel, and touch. Now, of course, you don't need $250,000 to go out and start investing in real estate. You can start investing in real estate with significantly less, but what I'm trying to say is if you have excess cash, now you can start generating a return from this cash. Real estate is not going to make you rich because you need a lot of cash to get started, and you might only make a 5 to 10% return on this cash. So it's very hard for regular people to get rich by investing their money in real estate unless you become more of a flipper, or you can sell these properties for a big profit, or you become much more actively involved in real estate. But real estate over the long term has proven to be a great place to save money. It's proven to be a great tax haven, and third, it's a great way to generate cash flow. Now, I've kind of been touching about this the entire video, but the reason why I invest my money in real estate is because it creates a cash flow stream. And if you do it correctly, this cash flow can be generally passive. Because now if you go out and buy a property, and we'll make it a little bit smaller. We'll call it a $100,000 property. And I know some of you are thinking, but Jaspreet, where in the world am I going to find a $100,000 property? They do exist. You look in the Midwest, you will find properties for under $150,000 in good areas. Now, if you go out and buy this $100,000 property, well, my goal would be to get a 7% cash on cash return on my money. Meaning, if I bought this property cash with no debt, that means I want to get $7,000 worth of profit cash flow every single year. Now, the return and the risk is I have to put in $100,000 of my own cash to buy this property. You don't have to put in all cash. You can finance the deal. You can find investors. You can do creative financing. There are a lot of ways to get the cash to finance the deal. But to keep it simple, I'm going to assume that I bought this property all cash. I had $100,000. I go out and buy this property. And in that case, it's going to generate $7,000 worth of profit. This is the type of return that I'm looking for when I invest my money in real estate. Now, for me, I want this cash flow to be as passive as possible. And in the beginning, the reality is real estate is going to be anything but passive because you're going to have to find the right team. Who is a good property manager? A property manager is somebody that you hire whose sole job is to manage your property. They're going to find a tenant. They're going to handle the repairs. So if the toilet breaks in the middle of the night, they call your property manager. They don't call you. You got to have a good attorney. You got to have a good accountant. You got to have a good real estate broker. You got to have a good real estate inspector to walk through the deal before you actually buy the property. And you have to make sure that all these people are working together. Now, this is going to seem super overwhelming in the beginning because when you get started, there are so many things that you don't know. And the more you learn, the more you realize you don't know. But once you get started, you'll see that one person will help you find the next person, and the next person will help you find the next person. It is a process, and it's a part of the game. You have to go through this initial learning hurdle, which is very difficult. It's time consuming, but once you do that, then real estate investing can be much more passive. Now I have a full team. When I go out and invest in a property, I meet my property manager there, I meet my contractors there, I meet my broker there. We go through the property to see what needs to be done, and then my property inspector will also tell me, this is what's good about the property, this is what's not so good about the property. Now I can see if it's a good property that I want to invest in or not, and if I do want to invest in it, my contractor will give me a quote on how much it's going to cost to renovate the property. If I like this, I'll show it to my property manager, they'll tell me what I can rent it out for, and then I just hand it off to them. My property manager knows exactly what needs to be done, and then every month I get a report, and every quarter I get a report from all of my properties. That way I can see what the profits, what my losses are. This sounds very nice, but it took a lot of pain, a lot of time, a lot of hardship, and a lot of mistakes to get there. Now I can talk about the different things that you need to do, and I have lots of videos on my channel where I talk about that, but you can't bypass the mistakes. You can't bypass the experience. It's a part of real estate investing. No matter how many real estate books that you read, no matter how many real estate videos that you watch, you can watch my videos where I go through my worst real estate deal ever. I'll link that for you down in the description as well. But you're going to learn a lot from that. Things that you won't read in books. But no matter how much you learn, I can guarantee, this is one of the few things that I can actually guarantee on this channel, you're going to run into new problems that you never heard of anybody else dealing with, and it's going to teach you a new lesson. That's what real estate investing is, that's what business is, that's what entrepreneurship is, but that's a part of the process. And you're also going to learn how to build the right team, and if you can build the right team, then this cash flow can be much more passive. Now, is it completely passive? No, you still got to review the reports. You still got to review your property management company, and you still got to make sure that your team is working good. But once you know how to do it, it becomes significantly easier because now you have all the processes in place to systemize your investment in real estate. And now your goal is, how can I increase my cash flow? How can I buy one property a year that way I can just keep upping my cash flow? You just stack in that cash flow, $7,000 a year from this one, then the next one, another $7,000 a year, then the next one, another $7,000 a year. And now in a few years, now you start stacking that cash flow, and now you have some significant cash flow coming in from your real estate. It sounds difficult, and it is, but you have to get started. The first deal is always the hardest. Once you figure out how to acquire the deal, once you figure out how to find a good location, once you figure out how to finance the deal, once you figure out how to do it, well, now it's just about rinsing and repeating and improving the process again and again and again. There are so many different deductions, so many different things that you can do in real estate to allow you to make money and pay less money in taxes legally. And your accountant has to understand and specialize in real estate investments because there is so many different types of deductions, so many different legal loopholes that you can use